welcome to this week's episode of Coinscrum Markets. I'm Nisa. Coming up, Guilhem Chaumont reviews the latest movements in the Bitcoin options market. James Bennett returns to analyze on-chain data and on-chain reaction. I'll be speaking to Nic Carters of Castle Island about the latest thoughts on Bitcoin, DeFi, and beyond. And Teana is joined by BitOoda's Sam Doctor to discuss their recent report. First, a look at this week's blockchain industry news. Bitcoin smashed 11K, up 18% last week, with market cap back to 200 billion, which aside from technicals, could be the growth of DeFi, NFTs, and a declining global macro backdrop. The OCC announced that all nationally chartered banks in the US could provide custody service for cryptocurrencies. Until now, digital asset custody has been done by BitGo, Anchorage, Curve, and others, and people are wondering if there will be acquisitions announced soon. According to the mid-year review, Coinbase has grown its client base to more than 35 million retail and institutional clients, a figure up 30 million from the beginning of the year. Most importantly, it said many larger and more conservative institutional investors are allocating for the first time, using Coinbase to build direct positions and backing crypto fund managers as part of their alternative strategy. In DeFi, reached a new high of 4 billion, up from 3 billion last week, 1 billion in Maker alone. And security token exchange T0 sees 1,500% growth and listed the Aspen token, representing the St. Regis Resort, a 5-star hotel in Aspen, Colorado. Signature Bank's deposit grew 1 billion in Q2 out of the 8 billion overall deposits based on their blockchain-based payment platform, Signet. Finally, at its 5th birthday, Ethereum is a rocket, up 30%. Ether more than doubled this year. However, Ethereum must complete its ambitious and fraught retooling of its foundations, the long-awaited move to 2.0, because gas fees have gone from 4 cents to $1 this year. Don't forget to click to subscribe to our channel for more updates. Next up, Crypto RFQ.
Thanks, Nisa. I'm delighted to be joined by Guilhem Chaumont from Flowdesk. Hey, Guilhem, how are you?
Hi, I'm good. How are you?
I'm very well, thank you. So we're going to talk a little bit about the markets today. Bitcoin's open interest is still on the rise and surpassing previous all-time highs. What's this being driven by?
So it's very interesting because the last time we discussed about open interest, there were already a huge surge in the open interest driven by derivatives, and it was very interesting, to wonder whether or not this will continue. And for July, it's definitely continue. We have like new all-time highs, USD wise, BTC wise, we're a little bit under still. Basically, it's the same story. It's institutionals are trying to get exposure to Bitcoin through various ways. What we see on the futures is that the premiums are already quite high. So options are a very good way to get exposure to Bitcoin.
Yeah. So CME shares have been down 50% after a 10x increase since May. And so it looks like the institutionals are looking at short-term options with close strikes. What is that a fair assessment? What do you think is happening there?
Yes, so about CME, it was really crazy because in May and June the volumes just went up to around 400 million USD of open interest. What we see in July is that this is a little bit down, and when we look at the strikes, actually it's all between 10 to 20k, but not higher. And it's mostly calls exactly the same way it was in June. So we have actually a ratio of around 10x between the calls and the puts. So what this means basically is that people trading there are obviously a bias to the upside, and in terms of prices, they don't target a huge bull run, but more a slow increase of 20% during the next month. At least that's what they're betting on.
Okay, and so we've been talking for a couple of weeks about Bitcoin do something. The price has been relatively stable until a couple of days ago. We had a bit of a price movement. What's going on with the volatility? Seems really low.
Oh, so volatility in July was just like it was the first thing that we saw. Volatility, the realized volatility was below 20% in July, right before the huge rush that we are witnessing right now. So that's actually lower than the 3 months realized volatility on the S&P 500. So it looks like Bitcoin itself is like becoming a stable coin. At least that's what we thought, before we witnessed the $2,000 rush that we are into right now. So I mean, this is both positive and negatives. Most of the observators would say that this is positive because volatility is good to reassure people to invest in Bitcoin, to use Bitcoin as a mean of payment. The truth is, in July, this low volatility has more or less negatively impacted the actors in the market, especially us as market makers, because we need volatility to do trading. So I would say that low volatility is it's good for Bitcoin in the long term. But definitely in the short term, it's still a speculative investment device. So at the end of the day, volatility is good, but it's really interesting to see that volatility all in is always getting lower and lower, and Bitcoin is more or less tending towards digital gold in many ways actually.
Interesting. So we spoke earlier about a large portion of CME options being in the money. What did you mean by that? Tell me a little bit more about that.
So yeah, basically when we looked at the picture of the options on CME last month, it was interesting to see that most of the options were out of the money. We had around 1.6% of the options in the money, which means that in terms of sensitivities to the markets, the sensitivities were nil, basically. Right now, it's a complete different story. Because of the moves we've seen in the last 3 days, we have 35% of options, calls actually, that are already in the money. So I think this is a good sign of what can happen in the next days in terms of volatility in the markets, because now these portfolios, they have a huge delta sensitivities to the market. And in terms of re-hedging, some things will definitely happen, despite that the open interest are still a bit lower than last month. So with the settlement that's coming in the upcoming days, I definitely think that this is something that should be watched because we're going to see some great stuff, along the moves that we see on the spot markets.
All right, fantastic. Guilhem, thank you so much for joining me again for another RFQ. We'll have you back in a couple weeks and see what the market looks like then.
Thank you so much.
Thank you. Back to you, Nisa.
From starting out as a dorm room Bitcoin hobbyist to becoming a respected commentator on crypto economics to co-founding both Coinmetrics and Castle Island Ventures, Nic Carter's never been far from an erudite opinion on Bitcoin and its competitors. With the current macroeconomic environment set to test many of his long-held views, Nic joined me this week to share his latest thoughts on his favorite subject. So welcome, Nic. Thanks so much for joining us today.
Thanks for having me.
So we seem to be moving into the exact economic environment that Bitcoin's earliest and most vocal advocates assumed would eventually occur, and where Bitcoin would thrive. Are we there yet?
I don't think Bitcoin needs any particular circumstances to thrive. I certainly think that the world that we're in right now, where we have pretty rampant monetary experimentation from every major central bank, certainly suits Bitcoin very well. But I think Bitcoin would have grown up just fine regardless of the monetary environment, because it's so differentiated from the tools that exist, and it does something pretty unique anyway. So I don't think it actually needs any specific catalysts or conditions to grow into its full potential. That said, if you look at the world today, M2, that measure of the money supply in the US, is growing at something like 25% annualized. M1 is growing even faster. It looks like we've entered a new kind of political regime in the US where both parties agree that the debt should be monetized. There's no party of fiscal responsibility left. And we're entering this world where there's a political demand for handouts direct to individuals, financed by monetary issuance, as opposed to, the traditional ways that things are financed. And it's not looking likely that the debt is ever going to decline here. So I think the way that the debt load is reduced is through devaluation. So mindful of all that, it certainly looks like we're in for a pretty rocky decade from a monetary perspective. So yeah, I mean, things couldn't be better for hard assets like gold and Bitcoin.
Mm-hmm. And what about the pace of development of the Bitcoin network? What do you think about that versus Ether? And are you seeing any innovations that excite you?
Yeah, I would say Bitcoin has a very different approach to development than Ethereum does. And that's totally deliberate. And I'm absolutely fine with that. I think most Bitcoiners are. The key thing is to not screw up the money. We're talking about right now $200 billion worth of people's savings, give or take. So making aggressive changes to that, potentially breaking changes, is not something that Bitcoin has really signed up for. And that is reflected in the core developers' hesitance to push through new changes, without full consensus. So the hesitance we're seeing around the Schnorr Taproot activation right now makes sense to me. I certainly hope that it doesn't take some of the timelines that are being proposed are pretty lengthy. So my wish is that we get it in under 12 months, but I completely understand that we're building a multi-decade project here. So, being extremely careful about new incremental changes and making sure no entity is being economically privileged through access to kind of the development team, that there's no preferential treatment, there's no corruption, basically. That's by far the most important thing. That's what allows the money to remain neutral. Now, if you compare that with Ethereum, they've gone for a very different trade-off. They have opted to have much faster innovation, a much more rapid pace of development, which also opens the door to effectively capture of the kind of core development teams by projects that need slight changes to the project, to the protocol. And that's not necessarily bad. It might mean that the Ethereum protocol is malleating to be more in line with what certain influential members of the community want. But it does open the opportunity, it creates the opportunity for potential sort of graft, corruption, handouts. For instance, any proof of work change would be a direct wealth transfer to whoever was most equipped to kind of monetize that change. And that's the thing that really concerns me. So I don't begrudge that of Ethereum. I think that's a specific trade-off that they make. But I wouldn't want that in Bitcoin because there's only one Bitcoin. It has this amazing history and pedigree and brand. And we need to be extremely careful with that and make sure that we're stewarding it properly and not making too many breaking changes aggressively. So the pace of development is pretty much okay with me.
And let's talk about exchange infrastructure because it's clearly better than it once was and has survived some recent stress tests reasonably well. And you wrote an article about efficient market hypothesis earlier this year, concluding you thought that the Bitcoin market was comparatively efficient. Is clearing really efficient enough yet?
Yeah, that's a fair question. The main point I was making in that article was that the Bitcoin market is fairly informationally efficient, which means that it incorporates new information into the price in a fairly rapid manner. I did say that there are constraints to that efficiency, and one of them is the market's ability to absorb capital in a timely manner. And the exchange infrastructure is one of those constraints for sure. There is still a lot of regulatory uncertainty in the US as to how exchanges should be regulated. There's no federal regulator for exchanges. And all of these exchanges, for the most part, are regulated by the states in a patchwork of different regimes. You have a bunch of, most of the real liquidity is offshore, which complicates the matter. So yeah, I would expect a lot more consolidation. I would expect a lot of these exchanges to get out of the business of custody and outsource that custody to third parties. BitGo, Fidelity Digital Assets, those are some of the kind of emerging big custodians.
And now the banks.
And the banks. Yeah, I mean, there are already banks in Switzerland that are empowered to do crypto custody. Clearly, there's one or more banks in the US that are asking the OCC if they can be custodians. You have the Wyoming SBDI initiative, which potentially will allow banks to operate on a full reserve basis and be crypto custodians. So we're definitely seeing the crypto industry like cross the threshold and meet up with the traditional financial sector, which is really exciting. It's something that we've expected to happen for a long time, but it seems to be happening now. So I think that can only be a good thing if you have entities that can clear trades both on the kind of with Federal Reserve base money with access to the Fed window and can clear the crypto leg of settlements as well. I think that would be pretty powerful. That's obviously not something that every Bitcoin user is going to need, but it's just one of those incremental changes which makes the market much more efficient.
We agree. We've been waiting for the institutions for a while. And any weak spots you see if they should open the floodgates?
Yeah, that's a very good question. Having worked at one of those big financial institutions on a team that was looking at crypto, a lot of the questions there had to do with forks and potential protocol risks, which could undermine the infrastructure built on top of it, right? That's definitely something that a lot of these entities worry about. A lot of these custodians and exchanges will have a fork policy. I think network level attacks are probably not given the credit they're due in terms of potentially being significant sources of risk here. I don't even think we've really seen the potential for network level attacks explored that much. People just presume that Bitcoin is entirely safe. Bitcoin and other smaller assets, which are easier to attack. I think most of the big risks involve what, when some of these institutions move down the ladder and look at other crypto assets, I think there's significant risks which are understudied for smaller proof of work chains, for instance, for, interlocking smart contracts where you have this web of risk which isn't fully understood. Bitcoin is pretty ironclad at this point, but there still are questions. There's always the potential for a bug. We have a good amount of investment in oversight and kind of security analysis of Bitcoin, but it could always be more. It relies on the work of open source contributors. So I'd love to see some of these larger financial institutions that touch Bitcoin start to contribute back to, the couple dozen core developers that actually keep this thing running and keep it safe.
What about DeFi?
Anything specifically? It's just such a big topic.
We're talking about security risk, but in general, there's been exponential growth the past few months. And I know that you really, try and steer away from investing there because of risk. Could you talk about that a little bit more?
Yeah, DeFi hasn't been a core part of our mandate as investors. We normally focus on corporate equity as our vehicle to get access to the industry as opposed to tokens. So just structurally speaking, we're not very involved in DeFi. We obviously pay attention to it. In the last couple of weeks, it's become extremely frothy. I think that's evident to anybody on the sidelines. There's a lot of projects which have pretty extractive models, some which are effectively Ponzi's, unfortunately, that have yet to wind down. And I think we're going to see the moment the enthusiasm for DeFi lapses, some of these higher profile and more marginal projects will wind down. There's a lot of leverage built up in the system. And a lot of these systems are built on positive feedback loops, which work great when things are on the way up and then are extremely bad on the way down. And I can give some examples. I don't want to be, too critical of any of these projects. But if you look at the way these things are valued, for instance, you look at some of these lending platforms which have a proprietary token, and the value of that token is a function of the cash flows deriving from fees on that lending platform. You can conduct a valuation of that, right?
Mm-hmm.
And then there's an incentive to increase the usage of the lending platform in order to drive up the implied kind of annualized cash flows and drive up those valuations. And it seems, and then if you look at the actual what's driving the usage of these lending platforms, it's these airdrops or the yield farming of these novel governance tokens that are, or governance or possibly something else tokens that are being inserted onto them, which in turn drive up the usage of the lending platform. So a lot of the valuation is predicated on usage, which is kind of entirely self-referential. It all comes back to these tokens which are being kind of airdropped to users in this novel way. So if that story is ever punctured and users lose faith in the long-term kind of value accrual potential of the token, a lot of the volume on these decentralized lending platforms will shrink back down. And so you get this positive feedback loop on the way down, which has the potential to be really aggressive and really destructive. And I don't know if investors have fully reckoned with or rationalized this yet. So it's been an exciting few months for sure. I think there's potentially a lot of retail investors that are going to lose money in relatively short order here, unfortunately.
Right.
That said, some of the fundamental innovations that are occurring are pretty interesting. I mean, decentralized lending facilities being the most interesting among them for me.
Yeah, if you look at a project like Chainlink, which has been popular lately, and public oracles should help make future markets even more efficient. Do you think it's realistic to think that mass information can be programmatically gathered and disseminated like that?
Well, we have oracles in securities markets. They're just capital markets data companies. And their incentive to provide good data is just a reputational one, and it's a business model. They commit to serving up high quality and timely data under a service level agreement, and that's what they do. And I'm the co-founder of a data company in crypto, Coinmetrics, and they have similar service level agreements with enterprise buyers to provide financial market data to them under service level agreement, so they're liable if they fail to do this. Now, if you compare that with something like Chainlink, where you have this kind of centralized network of entities that are injecting data into smart contracts, we've seen failures there. We've seen those contracts fail to be updated for hours at a time. It's hard to rely on kind of decentralized ecosystem of validators or nodes. It seems like a nice idea. I think in practice, we've seen some of those failures already, even at the incipient size. A lot of the energy is premised on the value of the token, which is obviously volatile. We don't know what that's going to be in the long term. So this is kind of a boring position to take, but I think the best oracles are just firms which specialize in data provision and are happy to sign up to an agreement with a buyer to provide that data in a kind of timely and orderly fashion, and do that under a service level agreement. That's worked just fine in much larger markets for decades now. So
Right.
I don't really see why we need a decentralized version of that. This seems like a solved problem. And certainly, I'm generally against the creation of spurious tokens. I don't really see where the valuation derives from in that case. So, not to pick on Chainlink specifically, but to me, this is not something you strictly need a blockchain for. I'm pretty happy with strategic re-centralization. I don't see why a private company couldn't inject that same data onto a blockchain without the use of a token.
Mm-hmm. Yeah, very interesting. So are there any projects that you're particularly excited about right now?
Well, I'm excited about the prospects for Taproot activation and Schnorr signatures on Bitcoin. I think that's going to dramatically increase the efficiency of the usage of the chain, which has been a big theme for the last few years. And that's going to allow us to weather another bull run without fee pressure getting too significant. So that's something I'm keeping my eye on. I've been looking at Jeremy Rubin's check template verify project, which will add some more potential sort of smart contracting functionalities to Bitcoin. You can already do quote unquote smart contracts with Bitcoin, but adding covenants to Bitcoin would be pretty compelling, pretty interesting. And honestly, I think it's about getting the boring stuff right. Building up in a layered approach, facilitating inter-exchange settlement. So I think Liquid is going to have a good 12 months here. I think it makes sense for a certain class of transactions to move onto Liquid. Transactions which require privacy. They have their confidential assets protocol on there. Larger transactions between exchanges that effectively trust each other. They don't necessarily need to touch the main chain. So you could see it develop into kind of a clearing network. I think as the fee pressure on the base chain grows, the incentive to move off chain or near chain to things like Liquid and Lightning is going to grow, and I think their prospects are pretty bright here.
Great. Well, thanks so much for being with us today.
My pleasure. Thanks for having me on.
New York-based broker-dealer BitOoda, in partnership with Fidelity, published an in-depth report on the global state of Bitcoin mining last week. Their chief strategist, Sam Doctor, joined Teana to take a deeper dive into the data.
Thanks, Nisa. I'm delighted today to be joined by Sam Doctor, Chief Strategist at BitOoda. Sam, thank you so much for joining us today.
Thanks for having me. It's a pleasure.
Yeah, it's great to have you. So we're here today to discuss the recent report that BitOoda published in partnership with Fidelity Center for Applied Economics that provides an extremely in-depth analysis of the state of Bitcoin mining. And so for our viewers who may not know BitOoda, can you just tell us a little bit about you and your company and the relationship that you have with Fidelity?
Sure. So by training, I'm a semiconductor engineer. Spent most of my career at JP Morgan and then at Fundstrat, where I helped build out the crypto research while I was there. I joined BitOoda in November of last year to really head up the strategy, research, and advisory business here. Okay. BitOoda is an institution-focused, high-touch agency brokerage that's fully regulated. So we're probably the only entity that's regulated both by the SEC and by the CFTC.
Okay, so Bitcoin mining. Bitcoin mining has become a global industrial scale operation, which functions across an entire network, if not the entire public blockchain industry, depends on Bitcoin mining. So let's talk a little bit about how you collated the report. Who was included in your survey, and what was the geographical coverage?
Sure. So as you can imagine, Bitcoin is an extremely secretive industry. And so while we've spoken with a lot of miners, a lot of it was on condition of anonymity. So, especially because they're sharing essentially their secret sauce, which is their power price. But having said that, we spoke with about 67 different miners and several mining rig manufacturers, as well as resellers and distributors. And we covered information on about 153 different locations across 21 countries.
So Bitcoin mining is, as you've just noted, very competitive. and has moved, from bedroom to industrial scale operations over the past few years.
Yeah.
As I understand it, the most critical factors that miners need to take into account are the cost of electricity, the price and supply of the mining hardware, and the political stability in the region that they're located. So can you tell us what your findings were across some of those areas? For example, what's the current median cost today to mine Bitcoin? And is there one?
Yeah, that's a great question. So, what we did was identified power price for about 40% of the total network.
Okay.
And so based on that, sort of extrapolating from there, we estimated what the median price would be for the whole network. The power price appears to be about a 3-cent median. The range is from under a cent in some geographies and goes all the way up to about 8 to 9 cents.
Mm-hmm.
The median is about 3 cents. So at that price, the median price to mine a Bitcoin works out to roughly about $5,000.
Okay. All right. And how about the geographies? Does that play a key role? I'm assuming that, power is much more cost effective in some countries than in others.
Oh, absolutely. I think that China seems to be one of the lowest cost jurisdictions. We certainly spoke with several Chinese miners, but we have less information about China than we do for some of the other countries. For the US, we think that we probably spoke with miners accounting for about 80% of total US mining capacity. So we basically spoke with almost everyone. Okay. And that is also true for somebody, places like Iceland. But in China, we spoke with, I think, roughly about 15% of China's mining capacity. But in terms of the number of miners, far less than 15%. We spoke with some of the larger ones.
The hash rate recently reached an all-time high after a sharp drop after the halving event. And so even though the Bitcoin price remained pretty stable for a long time until just recently this week.
Right.
So why did this happen given the miners' revenue was effectively cut in half overnight in May?
I think that's a great question. And I think there are probably several different factors that play in. The first is the lower price power that you see in China, particularly with the hydro season. And I think that there might have been some migration of capacity from slightly higher power prices to lower power prices. Mm-hmm. What that meant is that older generation rigs like S9, which were temporarily non-profitable, returned to profitability with both the fall in hash rate initially and the lower power price. Okay. As hash rate starts climbing again, I think some of those older rigs might again become less profitable. That's a function of whether price can keep up as well. The other factors that I would say is there are a number of mining rigs that have been paid for months ago. And as you probably know, mining rigs can sometimes take 3 to 6 months of delivery time from the time you pay for them. So once you receive them, and especially if they're newer generation rigs that are more profitable than old generation rigs, you're going to turn them on. Mm-hmm. And you when you turn them on, the other thing to remember is you could turn off 2 old S9 rigs, which would generate about 28 terahashes, and replace it with an S19 rig, which generates 110 terahashes. So even without power consumption increasing, the hash rate could effectively triple or almost quadruple with nothing else changing, just simply getting a new rig.
Yeah. So many detractors over the years, I'm sure you've been asked this a million times, have argued that Bitcoin mining consumes such a large amount of energy that it can be only bad for the environment and a huge waste of energy. I spoke with Apple and Blandon at the Cambridge Center for Alternative Finance yesterday, actually, about this topic. Mm-hmm. And they have a Bitcoin mining index. So it's a little bit different than your study, but it kind of gives a real-time calculation of how much energy is being consumed by the Bitcoin network. And she gave me a stat that essentially the amount of energy that's being used today could power the University of Cambridge for like 312 years or something. Right? It's like, that sounds like a lot. So how much energy does the network currently consume? And how much damage is it actually doing to the environment?
So we estimate it consumes roughly about 7 gigawatts of energy. At this point in time, we think it peaked out.
Compare that for something for us. So
yeah.
how much is that?
So I think one of the things that people really think about are, you think about countries. I would rather think of it from an industry perspective. And, in our point of view, Bitcoin mining is essentially a form of computing power.
Mm-hmm.
And so the closest analog we might think of is the data center industry, which consumes close to 30 gigawatts of power a year. So that's about 4 times what the Bitcoin mining industry consumes. In terms of the mix of power, what's interesting is an industry like data centers needs to have incredibly high speed capacity. It has to have low latency. And so very often they're located right near where the demand is, which could be, for example, just outside of a major city to take advantage of high speed connections and low latency. So that power tends to be more expensive. And that power also tends to be just that tends to be essential power, so to speak. Whereas with Bitcoin, you can mine with a much lower bandwidth. You are very often in much more remote areas. And so you're using power that would otherwise go to waste. A lot of the Bitcoin mining power is hydroelectric power.
Yeah.
And so, especially when you think about China's flood season, the reason why they sell power to Bitcoin miners for as low as a penny per kilowatt hour is because the alternative to that is letting that water spill over the spillway and not generate any power at all.
Yeah.
So it doesn't, consume.
That's a big period of time, isn't it? It's something like from March to October.
That is a brief period of time, absolutely. When we think about the distribution that is, across the different geographies that we've looked at, we think that a substantial portion of overall mining capacity is renewable. So whether it's hydroelectric or geothermal in Iceland, for example, or whether it is wind or solar driven, some of it is also what we might call demand response driven. I think that's something that's not as big a piece yet, but it's really coming up. And so when you think about areas where there is a ability of the miner to shut down their capacity very quickly during periods of peak demand, that might be an opportunity to reduce the power price. And so I think that there are a number of different factors that mean that I think that power demand is not necessarily, I would say that it's a valuable power demand. Whether it's because it's incremental power that would go waste, power that's being generated in markets that don't have demand anymore, for example, where, that have regions that have deindustrialized to some extent, and so you have power capacity that is stranded. And and finally, I think demand response or load response solutions are an important addition to the stability of the grid.
Okay. So given the way that mining economics works, any significant price increase in Bitcoin means that its energy demand will rise in tandem. So, what does that mean for existing miners? What scale of funding will be required to support that type of growth?
Yeah, so that's really an interesting dynamic, because as the price of Bitcoin increases, miners make more money, which means that they have more capital to invest in growing capacity, as well as makes it easier for them to raise more money because it's an attractive investment for outside funding. And so as that increases, and with some lag, the capacity comes online, hash rate increases, and your earnings in Bitcoin fall per unit, per petahash of your own capacity. And so it's a little bit of a circular reference. And as a result, we sort of think about this as how far can hash rate go, and what would it take to get there? We think that hash rate, which is now about 135 exahashes, could get to about 260 in about a year, and 360 in 2 years. And to get there, it requires over $6 billion of capital investment. And that, I think most of that, probably roughly about 4 billion of that, would need to be external funding. Now that, of course, is a function of price. If Bitcoin went to $20,000, you don't need as much as external funding because you're making more money yourself.
Right. Fascinating stuff, Sam. Thank you so much for joining us. I could spend another 20 minutes digging into this with you. I will absolutely read the report. We'll have you back on again. Thank you so much.
Thanks for having me.
Okay. Back to you, Nisa.
Thanks, Teana. Next up, James Bennett is back for this week's On-Chain Reaction. Hey, James, welcome back. Great to see you.
Hi, likewise. Thank you for having me.
So we're in new territory, Bitcoin smashing through 11K. What do you think about network demand here?
Right, it's pretty exciting times. We saw really low volatility in the lead up to this breakout. I think we were down below sort of 25% annualized volatility, which for Bitcoin is super low. And during that time, we were seeing network demand steadily rising. So we had fees increasing, we had velocity increasing. We also saw spend increasing. And, we had from ByteTree, 4 out of the 6 indicators we usually track were on. And we saw this break to the upside. And it's been extremely exciting to see that play out over the last few days.
And miner revenue is close to 10 million per day. Is that right?
Right. It's looking super healthy. So, I think I mentioned on the show a couple of weeks ago how important the miners are to the economy of the Bitcoin network. And so seeing their revenues increase is actually really bullish for the long-term health of this industry and specifically the Bitcoin network. They now make up to 12% of the total revenues. That's fees. So 12% of revenues come through fees. Which is one of the highest levels we've seen, and that uptrend is steadily increasing. As an aside, I mean, what's really exciting about that is that when people are able to pay more fees, it means that they're able to get value out of the chain. So it's not just about sending a $1 transaction anymore. It's about securing gold or securing other layer 2 networks like Liquid or settling Lightning Network payments. Lightning is actually also at an all-time high. So the total value of Bitcoin locked in the Lightning channel is at an all-time high. And that basically means that people are able to pay more fees on the Bitcoin network. So it's all very exciting right now.
So what else are you seeing about interesting indicators like network velocity at 600%?
Yeah, so network velocity is the speed that coins move around the Bitcoin economy. And the 600% level means that the active coins are moving 6 times per year. So the faster the coins are moving, the higher the demand and the more pressure it puts on price. And again, what we saw during this low price volatility period was that network velocity started to drop off. People weren't transacting as much. The network velocity then increased and subsequently price started to rise. So we're starting to now head back towards that critical 600% level. And all the signs are good for Bitcoin right now.
And there's all these different narratives out there as to why. Some people say there's, fear of missing out. Some people say it's because of all the activity on DeFi and non-fungible tokens. Some people say it's correlated to gold and looking at the deteriorating global macro environment. You buying into these narratives?
Oh, for sure. I mean, there are so many different things driving Bitcoin's price. So you've got Grayscale on the one hand that's buying up pretty much all of the new coins that were mined in Q2 of this year for institutional demand that then leads to retail flows. Of course, the inflation hedge is real. So we've seen tech stocks dropping off last week after a magnificent bull run and strong recovery off the back of the COVID sort of liquidity crunch in March. And Bitcoin's held its own, against falling tech stocks. So, for sure in the macro environment, it's playing out. When you look on that buy side of institutional and retail, it's playing out. And then when you look at the actual use of the network, and as we showed, on the first slide, network demand, it's increasing. So all of these different things are contributing to this upward momentum that we're seeing right now in Bitcoin.
Well, thank you, James, as always.
Okay, thanks, Nisa.
Thanks, James. You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.